Hello, everyone, and welcome to KJH Insights, our monthly podcast. I am Sarah Bull, Managing Partner at KJ Harrison Investors. Thank you for joining us today on our podcast, where we provide you with an in-depth look at the biggest issues affecting the market and their impact on how we are building and protecting our clients' wealth. I'd like to welcome Andrew Csumrik here today. He's a portfolio manager and member of our investment team. Welcome, Andrew. Thank you for joining us. I'm looking forward to hearing your thoughts on the market today. How are you?
I'm good. Thanks for having me today, Sarah.
Great. I'm excited for you to be here. So just thought maybe what we could do for our listeners is reflect back a little bit on the year. So since March, Liberation Day, the market had a big crash in April, and there was massive uncertainty around tariffs. But then Trump really retracted on that, and the markets had a V-shaped recovery. And the S&P is really back, not far from all-time highs here, but with a very narrow market breadth. You and Peter talked about all of this in our investment webinar yesterday, but you also touched on some other themes. So I was hoping maybe you could talk to our listeners about what's on your mind, what you're watching, and what you're thinking about as an investment team as we head into the end of the year.
Yeah, for sure. I think yesterday in our webinar, we kind of had three different themes that we wanted to touch on because as we do the monthly, probably the main thing was the current market pullback that we're seeing at the moment. The overall headline declines in some of the indices like the S&P 500 isn't crazy, but when you go under the surface, we're seeing some of the big winners really of the past year really sell off. And, we walked through different areas that are maybe down 5, 10, even 20%. And then we talked about the bifurcated market and really what we're calling, and it's getting a lot of press, is the K-shaped economy. We're truly in a market and economy of the haves and have-nots. And then also because of where we are, we're halfway through November. We walked through a brief recap of third quarter earnings. And in general, we talked about a pretty good earnings season on average. But once again, there's a lot more going on under the hood. So, important to dive into individual sectors and even companies and in terms of what is going on in the earnings season. So those were probably the three main things that we touched on yesterday as that monthly recap.
Yeah, that's great. Okay, so let's dive into the K-shaped economy because I think that's super interesting. And really, it's, as you said, it's the widening divergence across consumers where lower income households are showing strain, but higher income households continue to spend. But how else would you define that dynamic that we're seeing today and what's driving that divergence?
Yeah, so the K-shaped economy, before I really get into it, I think let's just take a really high level view of what's going on in the world. And I'll use the US just because it's a barometer for the economy. Q3 GDP is tracking at around 4%. We've got inflation that has come back down around the 3% level, still a bit above the 2% target that the Fed is going after. But compare that to the 7, 8, 9% we had a few years ago. Inflation has come back down. Unemployment's still at historically low levels of around 4.3% today, but in the low fours. That's a very good unemployment level. That's a really solid economy if you just, think of it from a whole. But then we contrasted that with, one of the new data points that came out, and that would be consumer confidence. We cited the University of Michigan consumer sentiment, and it's near all-time lows going back to the early 80s. So it's pretty astounding when you think about all the things that have occurred in the last 40 plus years, that consumer sentiment is as bad as it is today when I just described an economy that looks like we're in pretty good shape. So what we kind of went through is just a ton of conflicting data when we see it all the time. Strategists can argue about how the economy is doing, and there's an abundance of data to support either a bearish or a bullish narrative. So, for example, you had that consumer sentiment at all-time lows, but at the same time, we also showed real disposable incomes are at all-time highs. And retail sales also at all-time highs. So the consumer on that side is actually doing fine. And it does have people confused. And I think that's what led us to kind of describing this K-shaped economy. And the reason it's called that is if you just follow the letter K, there's two arms of a K. There's an upward arm and a downward arm. And that upward arm of the economy they're doing well. It's continuing to grow. And these in general have been high income earners. You think of technology companies, large corporations, that upward arm has been driving the economy. And compare that to the downward arm, those are areas of the economy that are struggling, and those include low-income earners, some of the smaller businesses, and it's really describing an unequal recovery. But overall, when you say back to the 4% GDP, low employment rate, the economy is doing okay. It's just that the recovery really feels increasingly different depending on the arm of the K.
And what does that mean then to your investment process? So, how do you think about it from a portfolio perspective? And what segments of the economy then would be most resilient? And where are you seeing cracks?
Yeah, it makes it pretty interesting, and it feels like for the market, it's similar to the economy, right? You've got two arms of the K for the economy. There's two arms of the K almost for the market as well. There's more clear winners and losers. And we've really seen that if you followed any of what we've been talking about. It's been going on for a couple of years. You could use it as the S&P 500 market cap weighted index versus you could do it versus the equal weight index or even the Russell 2000, which are smaller companies. That divergence in performance is just showing those mega cap companies, the large cap businesses that are the biggest in the world, usually technology driven. Those are really outperforming, call it the average company or the average stock. And that's what we say when we say there's more clear winners and losers. Those big companies are driving the earnings growth. They're generating more cash flow. And so they've been a big driver. So what we're saying is just buying the market can be misleading or just citing the market in a way. In the same way that I said the average economy is doing okay, certain cohorts are struggling. The average stock market can be doing okay, but there's a lot of stocks struggling. And so this is showing up in weak breadth in the market. For us, in terms of investing, it's even more important to know the companies that you're invested in, the underlying businesses. We talked a lot about the consumer, and last quarterly earnings, there were companies that were down 20, 25% just on the back of negative read-throughs on traffic or pricing. And there are other consumer companies that are doing really well. So the consumer right now, the sector's probably doing okay, but underneath it all, there's some that are really, really disappointing and some that are doing really well. And so we say from our investment process, once again, just using averages, or we really need to go in and know on an individual company by company basis.
Yeah, I think that's been your narrative all year long is best in breed businesses and really sharpening your pencils around the due diligence you're doing on the companies we are investing in our equity strategies. And that's proved to be successful year to date in terms of performance. Can you give us more insight into how you're thinking about some of the positions you are looking at?
Yeah, so I think that one of the biggest things we like to look at is there's obviously all the data that comes out, and we can look at retail sales and consumer confidence and those economic data points. But we find even more important is to listen to what the companies are saying. They have the boots on the ground, they're dealing with the consumer day to day. And so if you just look at this past earnings season, I can cite a few companies there. Chipotle really kicked it off at the beginning. They're the QSR, quick service restaurant chain. And they were really citing that they'd been having a difficult time earlier this year, but traffic really got hit with that low income cohort, the younger generation. And so that kind of set the stage for some other companies that continue to cite weakness. United Parks is another company that saw their share price decline over 20%. And United Parks is the owner of SeaWorld, Busch Gardens, other theme parks like those. And they just really said once they get the traffic in there, in-park spending is good, but the traffic has been the biggest issue, and they kind of reduced their guidance as well. And then even Go Easy here in Canada, they're a subprime lender, and they cited deteriorating credit conditions, higher charge-offs. And so a lot of those were all to do with that lower income consumer. And so a lot of those areas are not going to be fixed overnight. It just becomes a difficult backdrop for those consumers that are struggling. And you compare that to other companies that are in the exact same sector, consumer facing. Expedia actually cited, that's the online travel company. They were citing acceleration in the US and longer stays and longer booking windows. Host hotels, they own the brands, the Ritz-Carlton, the Four Seasons, Hyatt, those hotel brands. And I like their commentary. They just kept saying they track their properties weekly and they're not seeing any slowdown. Their high-end consumer just continues to spend money. And so I think you have to really say so travel seems to be doing okay, some of those companies. Visa was reported as 8 to 9% transaction growth. So people are still spending, it's just where they're spending and you have to follow where that spending is still growing. And so those are some of the companies that we did cite on the one hand are really showing their customers hurting. Compare that to some of the customers that they're saying, listen, we haven't had any issues. The consumer is resilient, they're spending, and so you kind of have to follow those trends until something shows differently.
Yeah, I think that really relates back to what you said. Under the hood of the Q3 earnings really tells a very nuanced story, right? And I think that's a big theme right now. And it really lends to the idea that you need to do the due diligence on these businesses. So I just want to go back to just tech here because you talked about big tech, you talked about the narrow leadership, and tech earnings, I guess, came in and CapEx continues to move higher with those companies. Can you just touch on what's happening with the mega tech stocks? And you also mentioned that they did have a little bit of a pullback here, and maybe talk about that.
Yeah, I think it gets a lot of discussion for obvious reasons. The larger technology companies, they actually all reported earnings that were pretty good. They continue to grow. They are the driver of, if the S&P 500, I think it's going to come in around 15% EPS growth. They're the majority of that growth. And so it is the engine that is driving the S&P 500 to date. But obviously a lot of, the stocks have performed very well. And so a lot of those expectations are being built in. We are seeing a pullback right now. But again, I think that's healthy as long as it doesn't spread to, a wider correction. Things can't continue to go up in a straight line. And a lot of that is driven on the artificial intelligence boom that we are seeing right now. There's a lot of spending going on. And so we always say this transition is huge. It is going to change a lot of companies for the better over the longer term, but it's hard to get it perfect, the amount of spending that goes on. So these are being pulling back right now. We haven't seen anything to date that is really saying that this investment cycle is over, but I think we should expect these normal pullbacks that do come with the market, and it'll be the main thing is to know the spending that goes on for these companies. They are spending a lot of money, but the end demand is there. So we talk a lot about the fact that these mega caps are driving the market, but I think it is important to say that they do have all the growth. And so it's probably warranted that they have seen a lot of the outsized growth. We think that the market in general to go that next leg higher, we do need a broadening out in the economy, more industrial. Industrial has kind of been in a recession for a couple of years, but we don't think it necessarily has to be at the expense of this AI secular theme. It can continue in parallel paths. But right now, obviously, you never want it to spread out and you start getting more fears. But at the moment, we think the pullback from these mega cap companies, the fundamentals are still solid. And so it's probably healthy.
I think that's right. These companies just continue to spend more and more, really, right? And they are part of the bull market thesis. Just going back to the pullback that we're seeing right now, does it have to do at all with the 43-day government shutdown that we just witnessed?
Yeah, I think it's a good question because clearly it had made headline news every day. And we get asked that question to say what's driving a pullback. You don't actually know. You'll never actually be able to pinpoint it exactly what's driving. I think it does have an impact. It was the longest shutdown in history. There's a lot of economists trying to work out that it will have an impact on Q4 GDP. Is it a percentage point? It could be more. There was a lot of government workers that weren't getting paid at the time, but that hit to the GDP you probably get back in the new year in Q1. The biggest thing, I guess, would just be uncertainty and a hit to confidence overall. So I don't think it's necessarily the main driver of the pullback, but definitely a positive that they've moved on from the shutdown. And I think you could kind of tell the longer and longer it went on, the market was getting a little antsy about it. But I think even more is there's a lot of moving parts in a market. And so it probably was one of them, but I don't think it was the leading cause of the current pullback.
And what about the Fed cut rates as expected, but then Powell dropped a little bit of a nugget saying wasn't too sure what would happen into Q4 in terms of rate cuts. Any thoughts on that, or how is that playing into your thinking?
Yeah, I think at the time you could tell the market was unsettled with those comments, and it was probably, yes, they cut rates, but the more divided that the FOMC was at the time, and you could tell that from the committee. And I think it goes to the conflicting data that I talked about earlier. They're dealing with that same data that is conflicting. On the one hand, they see a deteriorating employment picture, and on the other hand, they are worried about some of those inflation fears being, a restoking of the inflation. So at the time, it did spook the markets a little bit. I think as we head into December now, it'll be even more interesting because the Fed is dealing with an unclear picture because of what we spoke about, that government shutdown. There's a lot of economic data that they won't have. We don't know when they're going to come out. It reduced the frequency of things that were coming out. We probably won't get the unemployment rate for October just because they weren't able to complete the surveys, or other data may get released late and then it's backward looking. So they're really trying to play catch up now. And so I don't know. I think it actually gives a little bit of cover for Powell and the Fed in general. If they're like, we're going to do either cut or not cut, but we're still trying to gather all the information. So I think December might actually be less important than it was prior. But all that being said, I think the more important thing is that we do believe the Fed is in a cutting cycle. The cadence of it might be less well known. How many cuts are they going to do? What does it look like next year? But I'd say generally the market cares more about the direction of if they're easing or tightening, and I do think they're in the easing part of the cycle.
Yeah, I think that's a really good point. I think from a long-term perspective, they're in a cutting cycle, and whether the shutdown, to your point, that they were sort of flying blind with no data, caused investors to de-risk a little bit in here. More important is the fact that we're in a cutting cycle. I think that's great. So, Andrew, I think we're getting to our time here. And I think these three themes of the pullback, the K-shaped economy, and really, as you said, what's under the hood of the Q3 earnings really gave our listeners a lot to think about. Is there anything else you want to touch on before we wrap up?
Yeah, I'll probably just recap a bit of what I was saying. Is looking at averages and the high level is not necessarily telling the whole story, whether you're looking at the economy or the market. It does mask a lot of what's happening. And this K-shaped economy, I do think is something that does need to be watched. I don't think it's anything necessarily new. I think it's been going on for a little while, but these things don't fix themselves overnight. I didn't cite them earlier, but McDonald's probably had some of the most telling commentary on their conference call, and we love listening to companies like that because it's just such a large business, right? They're in all 50 states. I think I read a stat that roughly 8% of the population visits a McDonald's on any given day. So they see everything. In their commentary, they had said it wasn't anything new, but they were really seeing a bifurcated consumer base, and their low-end consumer was down double digits in the quarter. But in contrast, their traffic growth from the high-income consumer was up double digits. And so that's a pretty massive delta for, you think of a pretty diversified geographically by McDonald's. And so I thought that was very telling, and it's something that we're going to have to continue to watch. But it's not just that part. There's many different parts of the market that once you dig into the underlying companies, that's really what we're focused on. And it's less so if you just look at those high level datas of what's happening in the market. It can kind of muddy the waters of what is really happening. And that's what we want to focus on going forward. And we think those are where you find some of the best investments, not only what to look for, but probably more importantly, areas to avoid, which is even, another part that doesn't get talked about enough in terms of investment process.
I think that's a good point, especially in a year like we've had where it's really being defined by contrasts. And you've got this almost, as you say, market going in two directions.
Yeah, for sure. I completely agree.
Okay, Andrew. Well, thanks. Really value your opinion, and I know our clients certainly do too. So thank you for joining me, and thank you to our listeners for joining us today. We'll be back next month with another issue of our KJH Insights podcast. Wishing everyone a happy November. And if you have any questions, please reach out to your portfolio manager or anyone in the investment team, and we'll continue to provide you with commentaries and updates as the market narrative unfolds. All of those are available on our website at kjharrison.com. Look forward to speaking to you again next month.
This podcast is produced solely for informational purposes and is not to be construed as an offer to sell or the solicitation of an offer to buy a security. The information herein is based on sources we believe to be reliable but is not guaranteed by us and does not purport to be a complete statement or summary of the available data. Any opinions expressed herein are statements of our judgment on the recording date and are subject to change without notice. Any unauthorized use or disclosure is prohibited. Receipt and/or review of this presentation constitutes your agreement not to reproduce, display, modify, distribute, transmit, or disclose to others the content, opinions, conclusions, or information contained in this podcast.